But I got to tell you, if you're worried about the actual level of employment, then it's a small revision. Say 800,000 sounds big, but in percent terms, it's less than 1%. Pattern's not all that different. We're still creating jobs. We're not going into a recession. What was I thinking getting worried about this data? I was thinking I could get people excited and maybe trade when they shouldn't.
Joining us live from the Chesapeake Bay area, Blu Putnam. Blu, how are you?
I am doing well today.
This whole week has been nothing but information and data on jobs, unemployment, ADP employment, jobless claims, and now the employment situation. The focus is on jobs anyway, right? At this point, the second part of the dual mandate.
Yes, the inflation has come down. It's not to the 2% target, but it's clearly not going back up. So the Fed has shifted gears and says now we got to pay a little more attention to jobs. It's a more balanced view from the Fed.
Yeah, I was talking to your protege earlier this week, Eric Norland.
Eric Norland.
And we were talking about all these revisions. The big revision that we just had, the annual revision, and then we had 86,000 revised down for June and July for this employment number. And even Eric, who never says anything bad about anybody, raised his eyebrows at that 800,000 revision.
First of all, it's not a revision yet. They told us that their March data was 800,000 too high on the level. But the actual revision occurs when they release data back in early next year in January. The 800,000 is always a little not so good with immigration, and we've had a lot of that. Then they spread that number out over all 12 months using their seasonal factors. You do end up with lower levels. I don't think it's going to be 800,000. I think it's going to be more like 6, but it doesn't really matter because the pattern's not going to change. They're just going to move the whole graph down a little bit. Now, I don't think it's as big a deal as Wall Street was trying to tell us, but they got us all excited about it. By the way, it happens every year. We just decided to pay attention this year.
Well, and they made a big deal of it, painting the picture that these numbers aren't to be trusted. You got to just look at it on a long-term basis. And if it's always adjusted this way, then you should expect it.
They're doing their job correctly. So it's not that you shouldn't trust the data. But I got to tell you, if you're worried about the actual level of employment, then it's a small revision. Say 800,000 sounds big, but in percent terms, it's less than 1%. Pattern's not all that different. We're still creating jobs. We're not going into a recession. What was I thinking getting worried about this data? I was thinking I could get people excited and maybe trade when they shouldn't.
Well, let's take a look at some of the charts you sent because they were pretty awesome. The first one, U.S. employment rate is a percent data available through August 2024 as of September 6th.
We went from 4.3 to 4.2. You can't even see it in this chart. 4.2 is a very low unemployment rate. Obviously, if you look over the 70 years of history here, this is not a recession forecast yet. Time for the next chart.
Net new payroll employment jobs.
Yeah, now this is the one where they revised the last 2 months down. So we are actually up from last month, even though we're down from what was announced last month.
Yeah.
This number bounces all around. It's starting to stabilize. Many economists, myself included, are looking that we're going to average more like 75 to 125,000 a month for the fourth quarter. And that's not a recession forecast. That's the end of the post-pandemic job surge. So we're finding a new equilibrium, but we are not going into a recession.
All right. So we're not going to hit the panic button yet, is what you're saying.
Oh, absolutely not.
Job openings.
What it tells us is that job openings are back to 2019. Same point, the post-pandemic job surge, it's done. Now we're trying to find out where our equilibrium is going forward.
New employment claims.
The non-seasonally adjusted has come back down pretty low. That's the red line. The black line is flatlining. There's nothing going on here unusual.
All right, let's keep rolling here. Everything is on point. CME FedWatch tool. Yeah,
this is the CME FedWatch tool. Now, this snapshot was taken before the data came out today. And if you looked at it right now, it's not that different. They've moved up. The 50 basis point cut has gone from 39% to 43, 25 from 61 to 57. The interesting thing about this chart for me is that we're entering the quiet period on the Fed, so they're not going to tell us anything after today. It's roughly 60-40, give give or take. And that debate is going to rage until September 18. Just for the record, I'm in the 25 basis point cut camp. I think the Fed doesn't have any reason to panic. 50 basis points would signal a distinct worry about a recession. If the Fed's worried about recession, they can cause everybody else to panic. Unless you really are sure there's going to be a recession, 25 basis points is okay. I mean,
I'm in the 25 basis point camp too. Right now, if I had to predict, I'd say 25, 25, 25. I don't think they care about the election. But next chart, Fed expectations as of September 5th, 2024.
Okay, the red lines are meetings. What this chart tells me is the market is thinking that we're just going to get a whole sequence of cuts. They don't want to make the first cut till they're sure they can make a second and third cut.
All right, let's keep rolling here. Where are we at here?
This is the number of 25 basis point cuts by the end of the year. 4 cuts, which is what the market's telling us as of last night, would be 100 basis points, 1%. Yeah, I just can't see a full 1% cut between now and the end of the year. But, hey, it could happen.
Yeah, no, I know. I think slow and steady wins the race here. Do you think that the Fed also has one eye on what the ECB might do?
Yeah, they have an eye on it, but they also could care less. I shouldn't say care less, but it's not going to influence their decision. The Fed really doesn't worry about the dollar. The ECB will tell you they don't worry about the euro, but they do.
All right, CPI. We're back to inflation here.
It's hard for me not to put one inflation chart in when we're talking about the Fed. But what you can see on this graph is we had an inflation surge, we came back down, and we got stuck. But we're not going all the way to 2. I don't know that the Fed is all that worried. They understand that inflation's gone down.
But we've been hit with 24 months, 18 months in a row with Fed guys saying, nope, we're sticking with our 2% goal. We're sticking with our 2% goal. I never thought we were going to get there either.
Well, they're sticking with their 2% goal, but they have changed their rhetoric a little bit to as long as we're making progress toward 2% and we're getting close, then we can start adjusting rates. But they're moving toward 2% so they can cut. And they will cut. I mean, they've told us they're going to cut. They're not going to go back on that.
All right. So let's kind of recap here. The Fed shouldn't be worried too much about anything, right? Jobs seem to be, a little bit weak, but no one's worried about a major recession happening tomorrow. CPI is going the right way, right? Inflation is going the right way. So a soft landing here?
In the words of Wall Street, the soft landing is in play, but I hate that analogy. And I'll tell you why. If you have a hard landing, the plane comes to a dead stop quickly. If you have a soft landing, the plane lands on the runway very smoothly and you come to a stop. We are not stopping, okay? We're going to continue to fly. It's just we're going to fly at a little lower speed and maybe a little lower altitude. Potential GMP is more like 1.5 to 2, maybe 2.25 max. We're no longer a 3% economy. We're not even a 2.5% economy on trend. The flight path slows down a little bit, and that's demographics, by the way. That's not the economy screwing up or anything. That's just the demographic headwinds of all of us baby boomers retiring and not enough young people and all this stuff. But anyway, yes, in the jargon of the press and Wall Street, we are in the soft landing scenario, but we're in the growth. We're equilibrating to a slower growth, but not that slow, 2%-ish.
All right. Well, that's all good news, Blu. Listen, I appreciate you being here, especially on a Friday. I know you have big plans. You're going to get some crab cakes or something in Maryland. That's that sounds awesome.
Yeah, my work week I think is about to end in 10 seconds. Whenever you sign off.
I have to wait. We're going to sign off right now, though. Again, Blu, have a great weekend. Thanks for being with us. Looking forward to our next chat.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.